Hello and welcome to Alamut Capital Knowledge Center for yet another myth-busting topic. Let's get right into it. If you ask most individual investors how to beat the market, you'll hear the same answer. Pick good stocks, strong companies, growing revenues, great products, and on the surface, that makes perfect sense. After all, if a business is doing well, shouldn't the stock also do well? But here's the uncomfortable truth. Most investors who focus on stock picking still underperform over time. Not because they're unintelligent, not because they didn't research enough, but because they misunderstand where returns actually come from. Let's start with a simple but powerful distinction. A good company is not the same thing as a good investment. Think about companies like Apple, Google, Tesla, or Netflix. These are phenomenal businesses, but investors who bought them at the wrong price or at the wrong time often experienced years of underperformance. Why? Because stock prices don't move based on how good a company is. They move based on expectations, and when expectations are already extremely high, even good news can lead to disappointing returns. This is the first trap most DIY investors fall into. They focus on stories, not risk. When you buy an individual stock, you are taking on something called idiosyncratic risk. This is company-specific risk. It includes things like an earnings miss, a product delay, a lawsuit, a management change, or maybe a regulatory fine. These risks affect one company, not the entire market. Imagine owning a restaurant. If there's a recession, all restaurants might suffer. That's market risk. But if your head chef quits unexpectedly, or the kitchen floods, that's idiosyncratic risk. When investors load up on individual stocks, they are unknowingly making big bets on these unpredictable events. Here's the key question every investor should ask. Am I being compensated for this risk? Decades of research show that roughly 70 to 90% of a stock's return is explained by broad forces: the overall market, interest rates, inflation, economic growth, and factor exposures like momentum or value. Only a small portion, maybe 10 to 30%, comes from company-specific factors. Think about that for a moment. You might spend dozens of hours researching a company, reading earnings calls, studying financial statements, following news closely, and yet, the majority of the stock's movement has nothing to do with that company at all. Worse still, markets do not consistently reward idiosyncratic risk. There's no long-term premium for taking it. Idiosyncratic risk also has a dangerous feature most investors, really underestimate. It's asymmetric. Let's say a company has bad news, maybe an earnings miss, a regulatory issue, or even a scandal. The stock can drop 20, 30, even 50% overnight. But when good news happens, gains usually come slowly, and they're often capped by valuation. This creates a skewed payoff. Losses are sudden and severe, while gains are gradual and uncertain. This is why so many investors end up saying, "I was right about the company, but I still lost money." DIY investors are especially vulnerable to idiosyncratic risk, not because they're careless, but honestly, it's because of structure. Most individual portfolios look something like this: 8 to 15 stocks, a few large positions, and heavy exposure to popular themes. That means one bad event can dominate the entire portfolio. Professionals don't invest this way. They don't just hope that nothing goes wrong. They assume something will, and they design portfolios that can actually survive it. Professional investors focus on risks that truly matter over time, things like market exposure, interest rate sensitivity, inflation risk, economic cycles, and factor tilts like momentum or quality. These risks are measurable, they're repeatable, and historically, they've been compensated. In other words, these are risks you want to take deliberately. So, a lot of investors, they think diversification just means owning more stocks. But, honestly, true diversification is about spreading risk. Once you own enough securities, idiosyncratic risk pretty much disappears. And, that's not a bug. That's actually the entire point. You're no longer dependent on just one CEO or one product or even a single earnings report, or even one sector. Instead, your outcomes are driven by those broader forces that really shape long-term returns. This is why, professionals rely on systematic, rules-based approaches. Not because they can predict the future, but because they don't need to. Rules remove emotion. Structure replaces intuition. Risk is taken intentionally, not accidentally. This is the difference between investing with a framework and investing with hope. At Alamut Capital, our philosophy is built around deliberately de-emphasizing unrewarded idiosyncratic risk and focus instead on things like diversification, quantitative signals, dynamic risk management, and thoughtful asset allocation. Our goal isn't to predict the next big stock, it's to build portfolios that compound consistently across cycles. Stock picking feels productive, but structure is what actually works. Investing success isn't about being right more often, it's about being resilient when you're wrong. And honestly, the fewer ways your portfolio can fail, the better your long-term outcomes tend to be. If you want to move beyond stock picking and start thinking like a professional investor, we invite you to learn more about our approach at Alamut Capital.